Hello and welcome to our Scope webinar today. My name is Barbara Claus, and today with my colleague Runchao Li, we will lead you through the webinar today. Our theme is investing in Chinese equities, and that is more to that than investing just in the mega caps. I'm speaking of Tencent, Baidu, or Alibaba, which are part of the majority of portfolios, and a large part of the market is overlooked by many investors. But when you look beyond these mega caps, there are companies with the potential to outgrow the market and be real return drivers. And therefore, we have a fund manager from Rowe Price here, Wenli Zheng, who is the fund manager of the China Evolution Fund. He has been managing Asian equities since 2008, and we will speak with us about the current development in the Chinese markets and the outlook, and of course, the strategy he applies in the China Evolution Fund, which was launched in 2019, current investment team, and of course, the promising companies, where he looks for them and how he identifies them. Before we start, I have a few remarks. First, I would give you a little overview about T. Rowe Price. T. Rowe Price is the independent global asset management company, which was already founded in 1937, and it employs more than 700 investment professionals. It manages a broad range of active, equity, fixed income, and multi-asset strategies, and it's present in 16 countries. The current asset under management are 1.6 trillion US dollars, and therefore the majority is invested in equity strategies. So before we begin, thank you very much for being present so numerous today. And please remember, in case you have any questions for the fund manager, please type them into the chat window on the right-hand side of your screen, and we will get back to them at the end during our Q&A session with the managers. Now, I wish you a very good webinar. Enjoy it, and I will hand over to my colleague Runchao. Thank you very much.
Thank you, Barbara. And hi, Wenli. It's very nice to have you here. And as the start, maybe you can give us a little bit short introduction of yourself. And also, we noticed that you have been for 7 years experience on the managing HSP for the small cap fund. Maybe you can also touch a little bit on the track record there, please.
Yeah, sure. Thanks, Barbara, and thanks, Runchao. Thank you for having me here. And hello, everyone. Just very quickly about myself, I joined T. Rowe Price in 2008 and in 2008 after my graduation with MBA from University of Chicago. So I have been with T. Rowe Price for over 13 years. And in the first 5 to 6 years, I was the sector analyst, but it's a very unique setup. I managed to cover 3 totally different sectors in the first few years, including industrials, telecom, and internet. And that's actually, in hindsight, that's a very valuable experience for me because it trained me to look at things from different angle and trained me to understand there are different ways to invest. And then since late part of 2014, I started to manage the Asia ex-Japan sleeve of our international small cap fund. And the core of the strategy is to identify the small companies from the thousands of from a universe of over 10,000 stocks, and try to identify a few of those names that can eventually emerge as the leader and become a large cap company. And during that period, I think past 6-7 years, we generated about 8 to 9% annualized excess return in Asia ex-Japan. And in particular in China, I think in our IDF, in international small cap portfolio, we managed to generate close to 20% of the annualized excess return for about 7 years. And that experience that helped us to realize the great of opportunity in China market, especially among the smaller market cap range companies. And the second is help us to develop a framework which we think helps to capture some of those future winners and leverage on those alpha opportunities. And that's actually the trigger that get us to launch the China Evolution Fund in late 2019. And the fund basically is a combination of my experience as analyst and as original fund manager. So take a holistic approach, a style agnostic approach, not just focus on value or growth, but go after the best opportunities. And the second is to try to identify the future winners through the process of discovery.
Thank you. So before we come to the market overview, could you please maybe talk about your team and the interaction between you and your team?
Yep. So right now we have a structure of firstly we have the China dedicated team. So we have about 16 investors dedicated to China market right now, and we continue to grow the team as the market further expands. And at the same time, we also have regional experts sitting in our Asia office, Hong Kong, Singapore, Japan, etc. And also, as you all know, we have a great research platform in places like Baltimore and London. So our regional analysts as well as our global expertise, those are the great resources we as a China investor can leverage and get help from. And when it comes to the structure and how I interact and cooperate with the analyst, and in general, T. Rowe Price has a very decentralized structure when it comes to investment decision making. And as portfolio manager, what I hope to add value is to bring maybe broader perspective and bring my repeatable framework and also the pattern recognition, right? The patterns that I have seen in the past. But on the other hand, our research team, they are the key inputs for us in terms of ideas and in terms of the business insights. And you may know that many of T. Rowe Price fund has very long-term successful track record. And I would say that the research platform is the secret sauce for that. And on a more personal level, my own style is that I like to stay in the front line. So every year I conduct several hundred of company meetings together with the analysts, and I like to engage with the analysts on the early stage of their due diligence process because it helps them to understand my approach, and hopefully, and in some cases, I can help them to look at things from different perspectives.
Thank you. And as I mentioned, majority of your teams is mainly in the Hong Kong and Singapore. So maybe you could please talk a little bit on the advantages that you see for the local market presence.
Sure, Runchao. And historically, most of our analysts are based in Hong Kong and Singapore in terms of the China dedicated analyst. But actually earlier this year, I think in March this year, we opened our first mainland office in Shanghai. It's a research office. And the purpose of that is to tap into the local talent pool. And as an organization, we think of our advantage of combining the global expertise with the local knowledge. And China is actually a very dynamic market with rapid pace of change. And we think to conduct the comprehensive due diligence process to discover potential winners from the thousands of companies, and also to identify the changes earlier than some of our peers, we think it's essential to have the team and on the ground. And at the same time, as I mentioned before, that knowledge sharing among the T. Rowe Price global platform, they are also very valuable. And in many cases, it helps us to have the unique insights and identify the inflection points earlier. And that's especially relevant in some of the industries where the global supply chain are very important, such as technology, as well as some consumer business.
Thank you. So yeah, now we can move to the market overview. So as the start, maybe you could please give us some background information on the investing in the Chinese equities and also the current development situation in this country.
Yep, it's a very it's a topic that gets lots of attention. And as someone, I grew up in mainland China. So as someone grew up in China and right now live in China, I probably have more sympathy for the Chinese policymakers. And what we observed over time is, although the specific actions and the specific timing are difficult to predict in terms of the policy making in China, they are generally good consistency in the policy direction. And if we take the policies on property, healthcare, and education, for example, those policies are not really new policy. Many of those were introduced 5 to 6 years ago. And the government overarching goal is also well broadcasted, which is to lower the cost of living, provide equal access to quality education, and also to build a more equitable society. So those are the agenda behind the policies in those few sectors. And for the online platform, we think that the key objectives could be slightly different. And I kind of think of them as two major objectives. The first one is to create an open ecosystem, right? Instead of a walled garden of those technology giants. And the second is to better protect the interests of the relevant stakeholders, right? When I mean stakeholders, I mean consumers, suppliers, competitors, and maybe merchants. And because they usually have weaker bargaining power versus those online platforms. So you need third parties to step in to balance the power. And if we think about these issues that the government is trying to tackle, such as widening income gap, financial leverage, as well as the dominance of technology platforms, those issues are not unique to China. You hear those issues in many of the Western countries as well. And I think it actually takes determination to act on those issues instead of kick the can down the road. And we believe that those policies will help China's development be more sustainable over long term, despite in the short term it might introduce some of the volatilities as we have seen over the past few quarters.
So you mean that except for the short-term negative impact, actually, if we look at the long term, the third-party intervention is actually doing something positive and creating a more promising investment environment? Is that what you mean?
I would say that the direction as well as the agenda, I think those are well intended, right? And also that they are tackle some of the structural issues and everyone knows that what some of the structural issues are widening income gap, etc. And it leads to short-term disruption. But if we take 3-year view, 5-year view, we think that helps to build a healthier ecosystem as a healthier society. But of course, I would say that there are things they could have done differently, right? In terms of maybe better transparency and a better way of communication and put their framework out so people can better understand the policy framework. So I think definitely think there are things they could have done differently, but I think that the agenda and the direction of travel, I don't have issues with those.
And like more steady process for this interventions, right?
Yep.
Okay, thank you. And so would you think that the Chinese equity market is still investable? And do you think it has advantages to do the active management compared to the passive management?
Yeah, as I mentioned that I joined T. Rowe Price for 13 years. I actually joined 2 weeks before Lehman crisis. So over the past 13 years, every 3 to 4 years, China would have a mini down cycle, and in many cases driven by the policy. And at that point, there could be some people come out and worry about whether China remains investable. And if we look back in 2012, there were lots of concerns about the VIE structure and the ADR listing, right, in the US market. And in 2015, that was the burst of domestic Asia stock market. And also there was a period of concerns on RMB depreciation. And in 2018, if you remember, they were concerns about financial deleverage, which actually hurt some of the smaller private companies. And also 2018, we have seen a period of some of the policy coming out in terms of healthcare and properties, etc. So every 3 to 4 years, we have this mini cycle. But if we look back in hindsight, all those periods proven to be very good buying opportunities. And the other thing I'd like to point out is the cyclical element of the Chinese government policy making, right? And I think their philosophy is to repair the roof during the sunny days. And they tend to do the reforms. If you look at many of those structural reforms, the changes that came out, they tend to came out when the overall external economic environment is favorable, right? So such counter-cyclical move, we actually think it can make China's economy more resilient when the next external shocks happen in the future. And to the question of whether China is investable, I would just say that China is now the second largest economy globally, which is close to 20% of global GDP. And we also know that it's home to many of the great businesses. And China is different, and sometimes it's difficult to understand if we see it from the kind of the lens of the Western countries. But I would make the point that exactly because of it's different, it should serve a critical component in terms of diversification for global investors. And lastly, when it comes to your question about passive versus active, I think there's clear evidence of sustainable alpha generation in China, and we have done reasonably well, and many of our peers have done well too. And I think there are two reasons. The first one is that China is still a relatively inefficient market, and retail investor, they are still a major force in the market. If you look at the onshore Asia market, I think retail investors accounts for 70 to 80% of the total turnover, right? 70 to 80 to 80. And the average holding period is about 16 days, right? 1/6. So it creates lots of velocity as well as mispricing opportunity. And second, I think the reason for sustainable alpha generation in China is because of, if we think about index in general is a lagging indicator because it captures the current incumbents or the winners of the past. And in most of the markets, if the pace of change is slow, it's fine, right? But in China, the pace of change is so fast. So we think the active managers, they were able to identify the changes earlier than the benchmark in many of the cases. I can just give you a few stats, maybe would be interesting to you. I started as a telecom analyst, as I mentioned. 20 years ago, telecom was the largest weighting in the sector. In MSCI China, it had about 60% of the total weighting, so huge, right? And 10 years ago, and telecom today is like single digit, mid to low single digit. 10 years ago, financials was the largest sector with 40 to 50% index weighting. And today is internet, which is 40 to 50%. So there's a huge change in terms of the structure of the index, and it's a reflection of how fast the economy is changing. And that's quite unique to China. I think maybe to some extent US as well. But if you look at, we actually have done the study to look at Asia ex-China, the index weighting over the past 20 years has more or less been stable, right? It's just China that has constant and a very fast change every few years.
Thank you. And regarding the first point you mentioned regarding the proportion of the retail investors, to my experience, this is something that lasts for maybe 10 or more than 20 years. And would you think this trend might change in the future, or do you think it's going to still last for a long time?
It's a very interesting question, and it has cycled too. I think if you look back, China doesn't have the capital market history is not that long. But if we look at during the period of early 2000, 2002, 2007, those actually was a period when the retail participation was lower. And the reason is because of those are the period where the mega caps in China, like financials, like energies, etc., they have done very well, and those tends to be the stock that owned by the public mutual funds, right? So there was a period the mutual fund was doing better than the retail investor, so retail investors gradually exited the market, and then between 2010 all the way to 2015, the retail participation keeps increasing because there was a period when the Chinese economy was during some transition. The overall growth was slowing down. It was shifting from investment driven to maybe consumption driven and technology driven. As a result, the large cap and the blue chips were not doing well. It was all the small caps with lots of stories that were doing well. And those tends to be the stock that retail investors like to invest. So there was a period when the retail participation went further up. And when I talk about the number of 70 to 80%, the number today, the number actually was lower than several years ago. And the reason is because of over past 3 to 4 years, there was another period where the blue chips and the mega chips have done well, and many of the mutual funds have done better than the retail investor, right? So the retail participation does change through cycles, but at this kind of level, it's lower than what it was 5 years ago. And another point I'd like to make is that even today, even for the mutual fund managers in China, because of their investors have that expectation for them to be ranked top 3 like every month, right? So that I think that our peers in domestic Asian market, they were under tremendous pressure because they have been ranked constantly, and that really changed their behavior. And the result of that is their way of investing is not too different from the retail investors. They very high turnover, very short horizon, and also they all make huge bet on a few stocks or 1 or 2 sectors. So as we see it, we think that the market inefficiency, as we see today, could last for a long time in China.
Thank you. And maybe could you please talk about your opinion on the energy industry, and also considering the recent issue of the energy crisis and the coal price, and maybe also the long-term goal for the carbon neutral from the China's government?
Yeah, I think a few weeks ago there have been some concerns about the power shortage, and it happened in several regions in the third quarter. I think it's a combination of stronger than expected demand or power demand, which was growing at the mid-teens, and at the same time you have a reduction of coal supply in China, exactly due to the carbon emission considerations, but it only lasts for a short period of time, and you probably don't. If you don't hear it from the news anymore, it probably means that majority of the issue has been solved. And just yesterday, the national power grid, just came out and said that majority of these issues has been fixed. And so, in my view, it's a short-term disruption rather than a long-term structural issue in terms of this power shortage. But for in a more important question of what's China's goal on energy transition as well as carbon neutral goal, I think China is very determined for the carbon neutral goal. And besides the environmental consideration, it actually helps the China's energy self-sufficiency as well as industrial upgrade policy. And if you think about in traditional energy, fossil fuel, gas, oil, even coal, China rely on import, right? China is a major importer in terms of traditional energy. But in the renewable energies, if you think about solar, so think about wind, China is by far the #1 player globally. I think in solar panel, China probably has 80+% market share. In wind turbine, China has like 50% market share. So the energy, I think the energy transition definitely helps China in terms of industrial upgrade. And if you think about another piece of the carbon neutrality angle, which is auto, and which is a huge industry, right? And traditionally, China was relatively weak in the traditional internal combustion engine cars. But over the past several years, we have seen that the electric vehicle actually is an opportunity for China to leapfrog, and it has already become evident that China has probably built one of the most comprehensive supply chain in the electric vehicle, and now is emerging as one of the leaders in this area.
Thank you. So since we are currently talking about the ESG topics, maybe you can share some of your idea on the ESG trend for China in the future, and also maybe considering the market for the carbon emission, and how do you see this is going to develop and how it's going to affect the business in China?
Yep. So green transition is one area that Chinese companies have made significant progress already. And I can just give you one statistics. I think in June 2020, and in MSCI China All Share Index, I think only about 23% of the companies reported their carbon emission footprint. And 1 year later, in June 2021, the ratio almost doubled to 44%, right? So in a short period of time, the awareness of environmental issue has sharply increased, and the companies are taking actions to address this issue. And as we discussed earlier, that energy and auto, those are two very, very large industries, and both of them are going through the green transition. And Chinese companies are very well positioned. And the beneficiary are not just the ones like solar panels or batteries, which everyone can see, but it also provides the tailwinds for many parts of the value chain, right? So we will be able to identify some of the attractive business along the value chain. So enjoy the industry tailwind without paying a high price for those opportunities. And another thing I like to point out is that for our process, right, long before ESG become a well accepted concept, we always have the philosophy of we look for companies that are a stakeholder inclusiveness. So we speak to competitors, former employees, customers, suppliers, etc. And through this process, it generally leads us to companies with more sustainable ESG practices.
Thank you. And since we're talking about the long-term goal and the development for the market, there are also some other factors that might play an important role. So what is your opinion on the current birth rate and also the age structure of China right now?
Yeah, I think that the declining birth rate as well as aging population, those are strong headwinds for China. I think no doubt about that. And the government has woken up to this issue, and recently they have introduced some of the policies trying to address the issue. But we think this is a structural issue, is a long-term issue that cannot be easily fixed, and because it really involves people's lifestyle, right? And this kind of changes takes a long time to play out. And if you think about some of the policies like on housing or education, part of that is really try to lower the cost of living and lower the cost for people to raise kids. But it really takes a long time to play out, probably beyond our investment horizon, right? And on one hand, we think that the China's demographic dividend that has ended, but on the other hand, we think there's another education dividend that China is enjoying, and we think we are at the early stage of that education dividend. And about 20 years ago, when I was still at college, China has about 1 million college graduates per year. And today, 20 something years later, the annual college graduate is about 9 to 10 million, and many of those are in engineering or technology majors. And if you look at some of the statistics, right, China today, the R&D spending accounts for over 2% of GDP. The ratio itself is actually higher than EU right now. So we think that the China's competitive advantage is now quickly shifting from labor arbitrage to innovation as well as technology. And it's already reflected in the public market, right? Over the past 3 years, if we look at the public market, just from internet, biotech, and electric vehicle, 3 sectors alone, there has been an increase of $2.5 trillion of market value, just from those three innovative sectors. And the other part of the demographic change is that we have also observed the acceleration of in automation and enterprise software adoption, and those were the two sectors that the penetration in China was very low in the past. But as labor cost rises because of the demographic changes, the return on investment from automation and IT has significantly increased over the past few years. So this is also an area that we are seeing increasing opportunities.
Thank you. And yeah, sure. So for the issue of the birth rate and also the age structure, this is also something that is strongly linked to the living cost. And mentioning about the living cost, I think there's also one big important component, which is the real estate. So what is your opinion on the historical development of the real estate industry, and maybe considering the Evergrande Group as an example, how do you see the impact for the recent default issues?
Right, Runchao is a very, very relevant question. I think property has been a very critical driver for China's economy over the past 2 decades. I think it's now over 20% of the GDP coming from the real estate supply chain. So it's a huge industry, but the boom in the past also create some of the side effects that we all know, right? That the widening wealth gap, that is a huge gap between people who have property versus those don't, and that rising cost of living, and also the financial leverage in the system. And that's exactly the reason why the government is so determined to address the issue. And many of those policies actually started 5 to 6 years ago. So we are now in the 6th year of this round of tightening cycle. And I think structurally, if you think about longer term, I think property will increasingly be a smaller part of the economy over time. So I think the government direction is not going to change. And on the other hand, we also think the government would try to avoid hard landing scenario. I think they want to hopefully they want to engineer a softer landing type of scenario, and we do think they have the necessary tools and to control the contagions from the Evergrande incident. And over the past few weeks, I think we are already started to hear some of the news flow that there were some selected loosening of the over stringent policies in certain cities. So I think we might have already reached an inflection point in terms of the over tightening of the property sector. But I think structurally things are not going to change. And from our perspective as investor, we think property development business, they will face structural tailwinds, structural headwinds over the next few years, both in terms of growth as well as margin. On the other hand, we see great opportunities in the after-sales market because of all the properties sold over the past 2 decades. Those needs to be serviced, and that's why we are quite positive on property management service business, because this is a cash generative recurring business and also have a long runway for consolidation.
Thank you. And since you also mentioned that the wealth gap is currently an important issue in China, so in this case, how do you see the recent success in the Chinese action for helping the poverties happening in the previous 1 year?
Yep. Many of those policies takes time to play out, but I'd like to give you some of the specific policies that have achieved significant success. The first one is healthcare. 15 years ago, I think maybe slightly longer, 15, 18 years ago, the healthcare coverage of Chinese population, I think, is about maybe in the teens. And today, 95% of the population in China has some sort of healthcare coverage. So there's a substantial increase, right, in terms of healthcare coverage. And we hear lots of the policies of the government tries to cut the drug prices, etc. That led to some of the volatilities in the healthcare stock. But if we take a step back and think about what the government really try to achieve, right? So what they want to increase the healthcare coverage to improve the welfare of the general public, but at the same time, the budget is limited. What you do, right? What do you do? You keep increasing the coverage. You keep have more drugs in the coverage, but your budget is limited. The result of that is that the generic drugs as well as devices, undifferentiated devices, will have a constant pricing pressure, and that drives all those drug companies to actually to innovate, to become a biotech companies and to compete in the global market. So I think the result of this has been quite clear in terms of the healthcare sector. So that the overall welfare increased, but at the same time that the pharmaceutical companies in China, they have to change their model, now become a more innovative driven rather than kind of sales force driven. In education as well, right? Education that we see lots of noises, but I think that the general principle for education is to provide equal access for education. So the best schools, primary schools and middle schools in China, in most of the cities, the best schools are the public schools, right? So you get to those schools not because of you pay the highest price. Actually, most of the schools are free, and they allocate the slots by where you live, by how long you have been in the cities, etc. So I think that's their way to provide equal access to education, which in turn is a very important component for better social mobility, right? So those are the issues they try to achieve. And the third point is the numbers you can see in terms of the property, the number of people that's below the property line, poverty line. I don't remember the exact number, but I think that over the past 20 years, the total reduction in terms of people below the poverty line in China has been higher than the rest of the world combined.
So thank you for sharing your experience and idea on the market overview. So maybe right now we can move to the fund and the portfolio specific topics. So for the first question, for your portfolio, you're looking for the outliers with the standout performance potentials. So could you maybe explain a little bit on how these outliers can drive the performance, and how do you identify those outliers? So maybe also, is there any specific sector or investment themes that the majority of the outliers belongs to?
Yeah. So if we analyze the market return over 3-year period or 5-year period, and in China, that over the past 10 years, only about 3% of the stocks had an annual compound return of over 20%. But those 3% of the stocks, they contributed 87% of total market return. And if you look at 3-year period, I think about 11% of the companies compounded at 20% or more, but they contributed over 100% of the total market return. So if you take out those 11% of companies, the market could have been down. And we actually have done similar studies for the US market, and the result is quite similar. So in both markets, there's a very small percentage of outliers that drive the majority of market return. So I think the conclusion from here is that as active investors, we think our priority is to capture some of those outliers. Otherwise, we'll just be a mediocre investor, right? And for the long-term outlier, and we call them the durable growers. So they tend to emerge in large industries that are undergoing structural changes. And we are looking for companies with strong competitive advantage, strong long runway for growth, as well as a strong management team. But for the medium-term outlier, if you think about 3 years outlier, they often occur in situations where there's step function change it can be the companies that are going through a product cycle. It can be companies that has invested in the past, invest heavily in the past, but now they are entering the harvest cycle. So, and also it can also be companies that going through the industry cycle, right? Because those are the situations that you usually come with margin expansion, earnings acceleration, as well as multiple and valuation expansion. And they may not be great stocks for 10 years, 20 years, but they can generate outsized return over a 2 to 3 year period. And in China Evolution portfolio, we try to capture both of these outliers.
Thank you. And so from your opinion, how do you see the advantages for the relatively smaller caps compared to the largest companies?
Yep. So China is a very deep market with over 5,300 stocks. I think in terms of number of public stocks, China now has more than the United States. But within that over 5,000 stocks, only about 100 has a market cap of 30 billion or above, which so roughly 2% of the total universe. But if we look at the MSCI China Index as well as the average China fund overseas, they allocate 60 to 70% of their assets into the 2% of the mega caps. So we think that those mega cap space, there is a possibility that everyone already own it. There's a possibility they are overcrowded from time to time, and we believe the rest 98% of the asset class, they are more underexplored and they offer more mispricing opportunities. In addition, if we go back to our study of the outliers, an interesting fact is that at the starting point, 99% of the 3-year as well as 10-year outlier we talk about in China, the starting point market cap is below 30 billion. So if we think about on average, people put 60 to 70% of their assets into the into the mega cap names, and on the other hand, 99% of the outliers, future outliers, are probably going to come from the area that come from market cap that's below 30 billion. So there's this huge disconnect, and so we believe that the space we operate in, the 98% of the space, we believe most of the future outliers will emerge from our space.
Thank you. And so maybe now we can come to a concrete example in the portfolio. So we can see that one of the top contributors to the portfolio is Li Ning. So could you maybe speak a little bit on this position in your portfolio?
Yep. So Li Ning is, for some of you who may not know, is a leading sportswear brand in China, and the founder is, I think, is 4-time Olympic gold medal winner, and the company actually fits one of the patterns that we observe, which is the rise of domestic brands. And the similar trend had happened in Japan and Korea decades ago, but now we are seeing very clear trend of it's happening, the rise of local brands happening in China. And Li Ning's brand has very strong connection, especially with the young consumers in China, so they benefit from that trend. And on top of that, we also think that Li Ning benefits from the disruptions of social media as well as e-commerce. And the traditional sportswear companies, especially the foreign incumbents, they build their business during the TV age, right? During when the supermarket or the KA channel was the key distribution channel. But when social media come up and e-commerce come up, the way to build brand and to distribute actually changed. And Li Ning is the front runner to embrace those new technologies. So it helps them to leapfrog some of the incumbents in the industry and build very strong brand momentum.
Thank you. So my last question would be regarding the performance of the fund. And so could you maybe speak a little bit on the performance of the fund previously, and also with considering the COVID-19 issue recently, how does it impact the market and how did it impact the portfolio?
Yep. So China Evolution was launched in late 2019. I think we had a lucky start in terms of performance in 2020. So in 2020, our return is above 60%, which is 28% ahead of our benchmark. And coming into 2021, we have seen some changes into the market leadership, right? Some of the blue chip stocks that have pulled back, and there are other areas that have done better. But we managed to have double-digit excess return versus the benchmark in the first 9 to 10 months of 2021. And we'd also like to highlight that our performance is not driven by a concentrated bet on a few names or few popular stocks or popular sectors, but it's really a result of stock selection across the portfolio. And in terms of COVID, and we will have winners and losers from COVID, I think, which is nothing surprising. And COVID has led to both volatilities, but also huge divergence of performance across different sectors. And this actually gave us opportunity to adapt and upgrade our portfolio. And over the course of past few quarters, and what we have been doing is that we have been shifting from some space that have done very well, which we think may be fairly valued, including some of the consumer names, healthcare names, and into the areas which we see better risk reward, including some of the industrial space and business service space. So I think the result of our excess return in 2021 is a result of our flexibility and our holistic approach to go after the opportunities and constantly adjust our portfolio to the names where we see best risk reward.
Thank you. And since we're talking about the COVID-19, I think at the current stage, we can still not say that it's completely over. And even in the future, when it's already completely over, it might still have some constant impact on some of the area or the business sectors. So how do you see this, and how would you incorporate this outlook into your portfolio?
Yep. So it's interesting. I think in China's experience, China is where that COVID first become a major issue, but the issue quickly came under control since mid of 2020. So China has a strong recovery coming out of that. But China is also adopting a policy of zero COVID, and I think China now is in a different cycle because COVID is difficult to eliminate totally, right? But China, the tight policy remains in place. So whenever there's a case pop up in some cities, that many of the business in that city will be impacted. And right now, the approach is basically to minimize the impact, to have the targeted lockdown instead of impact the overall economy. I think we are in this stage of this mini outbreaks for the near future, before the government finally make the decision whether to open the border or whether to change the policy. Otherwise, I think you will stay in this type of situation for quite some time. But I think from the Chinese government perspective, they think they have at the moment they have the optionality to wait, right? I think they want to wait to see how this winter plays out, and they can wait to see whether there could be some more effective vaccine as well as cures over the next few months before they make the final decision. But I think that they still need to figure out an exit strategy. I think in many Western countries that the strategy is also very clear, right? Which is to live with COVID, but China hasn't made the decision yet.
Mm-hmm. Yeah. So yeah, thank you very much, Wenli, for sharing your idea and the understanding of the market and your thoughts. So it was quite informative and quite interesting for us and for the audience. So far, this is all of the questions from my list, and I would like to hand over to Barbara.
Thank you, Runchao, for handing over to me. I also find it very insightful, especially for me as an European investor. We have covered a lot of ground, and this also has raised questions with our participants. They had raised their questions before the webinar and also during the webinar. So there is quite a list, and we try to ask you, Wenli, as many as possible. So I then would go ahead with the first question I've received from the investors. So the first question would be, Wenli, do you think the time is now right to invest in Chinese equities? And what are the risks and opportunities involved you see at the moment?
Yep. We are a bottom-up investor, right? So we don't really spend too much time thinking about the timing. But I would refer you back to some of the comments that some of discussions with earlier, right? So every 3 to 4 years that China would have mini down cycle, and many of those are policy driven. And I think the result of that is, I think the cycle in China could be very different from the rest of the world. I think China right now, I think the policy cycle probably has peaked out. I think that the balance is now shifting back to stabilize the growth. So I think that that's where we are in terms of the policy cycle. But on the other hand, that the earnings or the business fundamentals, they come with a lag with the policy cycle, right? The policy happens first, and then it shows in the real economy and drives the earnings. I would say that in the second part of this year, we have seen some slowdown in the economy, as well as seen some slowdown in some of the companies' earnings growth, and so that's the second element, right? The policy, the economy. The third element is really about valuation. The valuation also has come back substantially. And one thing about China interesting is that even when the market is very hot, when everyone is excited about China, we are still be able to find attractive ideas because it's just such a deep market. As I mentioned that at the beginning of the year, when China overall market situation was quite heated, right? China was very popular at the beginning of the year. We were still to find some of undiscovered the business model with very unique business and at attractive valuation. So I think in China, what I try to do is not to really think about timing, but to think about where are the mispricing opportunities, right? Where are the areas that we can still find attractive risk reward. And today I would say that we continue to find many attractive investment ideas.
Thank you very much, Wenli, for answering that question. I have another question on the indirect holding vehicles like ADRs and VIEs. European investors often hold stocks over these vehicles. So do you think we should consider regulatory risks here? And how should we as investors act? Should we choose, for example, rather A shares than ADRs?
Yep. That's also a very important question, and is important that's relevant to my experience. And I remember about 10 years ago, and that was also lots of concern around VIEs as ADR and as well as ADR structure. And I was the internet analyst back then, so I was at the epicenter of this event. And I remember at the trough, the companies like Tencent and the Baidu, they were trading at 10 to 12 times PE, despite they were still growing at 40, 50%, right? So that was an incident about 10 years ago. And the issue and the concern never really gets solved. But after 1 to 2 years, the investor just forgot about this, and things go back to normal. And then this time around, over the past few quarters, the similar concern was triggered. And I think this time was triggered by the intensifying relationship between US and China. And from China's perspective, there's no indication that the Chinese government may disallow VIE structure. However, if China and the US government, if they cannot reach programmatic solution on accounting auditing as well as data security issue, in theory, there's a possibility for ADR to delist. I think it's a low probability event, but it's not impossible. What's important to understand here is that there are now ways to mitigate the risk even in the event of ADR delisting. So if companies they list in ADR but they do a second primary listing in Hong Kong, they can easily convert the ADRs into the Hong Kong listed shares. And we see that many of the companies are already doing that, and we are encouraging all the companies that we invest in to do that. And And I think in 1 or 2 years' time, majority of them will have the second primary listing in the Hong Kong market. So I think by doing that, investors' interest will be well protected by the Hong Kong dual listing.
Thank you very much for answering that question. I have another question. It's concerning the geopolitical situation, but also the influence on the joint ventures. For example, Chinese companies also have joint ventures with European or US companies. And so do you think the rising geopolitical tension might impact these joint ventures? And what is your view on that?
Yep. It's interesting. I think that several years ago, China started to talk about the concept of dual circulation. Right? If you take a step back and think about the long history since the founding of Republic of China, it's now 70 something years. In the first 3-4 decades, it's all about internal circulation, right? That China was isolated from the outside world. Then since late 1970s, I think China actually depended more on external circulation, right? The export become a very important driver for China's growth. And also you see lots of joint venture, etc. Those were set up during those period. I think over the past several years that the increasing talk is about dual circulation. I think what it means, to my understanding, is on one hand, if they think that the domestic consumption as well as industrial upgrade, they are going to play a bigger role to drive China's future growth. And also the other element is to address the potential vulnerabilities in the supply chain. So I think that's what it means for the first part of dual circulation. But the second part of dual circulation is that I think they continue to emphasize opening up, and the talk is the higher level of opening up. And as you have seen that there are many policies introduced over the past 2 to 3 years, including that allowing the foreign financial institutions to have 100% ownership of their entities in China. Right? As I mentioned, that Rowe Price set up an office in China, and if we want to do business in China in the future, we don't have to go through the JV road. We can do a wholly owned entity, and also you see even in the auto industry, Tesla has 100% ownership of its operations in China, right? So I think that the continue opening up, I think that's the trend that's not going to change. And why China set up a JV in the past? JV is actually a structure of half opening up, right? If you want to do business in China, fine, but you cannot own 100%. You can only own maybe 49% or 50%. So it's a concept of JV. But now, especially if you think about auto industry, if you want to set up electric vehicle plants in China, you can have 100% ownership. So I think that the continue to opening up, I think that trend is not going to change, and especially in current environment, I think China is facing some pressure in terms of geopolitical competition. So it's really in China's own interest and own incentive to I don't know what's the right term for it, but to cooperate better with the foreign companies who are still willing to invest and operate in China.
Thank you very much, Wenli, for answering all our questions. Unfortunately, we have to come to the end of this webinar in regard of time, but it was very insightful for all of us, which you can also see by so many questions asked. In case we have additional questions, we will get back to you after the webinar. Wenli, thank you very much for being here today, sharing your views, talking about your investment process. And it was great to have you here, which you can also see by the large interest of the audience. And also, Runchao, thank you very much for being our China expert in the team and being the host today. And also to the audience, thank you very much for being here today. When you want to see a replay of this webinar, when you want to have more information about the fund or about the upcoming webinars at Scope, please visit us at www.scopeexplorer.com, where you can see all upcoming webinars and all the replays. If you have any further questions or comments, just let us know. And I wish you all a great day, and see you at one of our next Scope webinars. Bye.
Bye. Thank you. Bye.
Thank you.
Bye.